Hello, today we're going to be doing a video here on VICI Properties, ticker symbol VICI. And today we're going to be going over a valuation method for them. And currently we are here looking at their EPS, which you can see last year was 1.27. But over the last 12 months ending in June 30, 2022, it was currently at 2.19, which is a 116% increase. We're looking here at their shares outstandings. It does increase because it is a way how they can build their properties. Since they are a Reit, they're currently at 1,008 shares. We're going to come over here to the financials. We're going to look at, we're going to look at their revenue. And the revenue here has increased, year over year. As you can see, it was 2,601, and this is in billions, and now it's at 3,297, a 79% increase year over year the last 12 trailing months. So that is a good sign. Another thing to look into when you are looking at Reach is the AFFO, which is what we're going to do to project the discounted cash flow instead of using their free cash flow. They are free cash flow positive, but it's just a more accurate number for a REIT. We will check out their assets. Their assets, it is increasing. They're at 42 billion, and you come over here to total liabilities. You're going to see they're at 18. Long-term debt, they're at 16,624, and then their cash on hand, it is at 890 million currently. It's a 15% increase year over year. We'll also do that for a discounted cash flow too, but right now we're just going to stick to the main metrics and look at it. So we're going to come over here, and their last AFFO numbers, this is for 2022, was 1693. They're currently growing around 7%. So we're going to continue to give them that 7% growth rate. We're going to use a 10% discount rate and perpetuity of 2%. If you come down here to shares outstanding, and then we get a discounted cash flow price of $30.71. Here's our discount rates, and as you can see, this is very similar to where they're currently trading at, which is right around the $30 mark as of today. We're going to come over here to our dividend discount model. We have a current dividend of 1.66 annually. They're currently growing that dividend at 6%. It was a little bit higher than that for the increase this year, but we're going to keep it around a 6% rate and then give ourselves a discount rate of 10%, which is going to bring us to $43.99, which would mean that we are potentially undervalued for VICI right now. Which, a lot of their properties are heavily invested into Las Vegas, which is a really good place because it's always growing and it's always popular, and I'm going there in October and I can't wait to go. But if we give ourselves a 20% discount rate, it's going to bring it down to $35.19, which would still be discounted and still undervalued at current levels if these assumptions are accurate. And we're just going to go ahead and use a Benjamin Graham. We're going to do the 2.19 for the trailing 12 months, a 7% growth rate. Corporate bond rate 4%, and we're going to do a PE of no growth of 12, and that's going to bring us to around $29.08. So that would mean it's a little bit undervalued according to this Benjamin Graham method. And then if we come over here to our final value, we have $30.71 for discounted cash flow, our dividend discount model of $43.99, and our Graham model of $29.08. This brings us to a final valuation of $36.53. And then you have your discount rate 10%, 15%, and 20%. Even at 15% discount rate from this valuation, VICI would be undervalued currently. But we are going to come over here to our dividend discount model that is aggressive. And we're going to go ahead and enter in those same assumptions, 1693. And then we were saying a 7% growth rate, a discount rate of 10% with perpetuity 2%, outstanding shares 108, and we want to change this cash on hand. We want to see what things are going to look like. So we're going to do our 890. Let me put this in here since it's all in millions. 890. Our total long-term debt. Sorry, I'm finally getting better from being sick, but that cough just lingers. And then we're going to have 161,624. Oops, that is one too many sixes. Right? So 16624 is going to bring us negative. We're going to bring it over here, and as you can see with our cash and our debt on hand, it's going to bring us to $24.08 84 cents if we're using these on there, which is not a good way to do it since they're going to tackle down the debt and they're going to issue shares and continue to increase their cash on hand and stuff like that. But it is a way to value it, and this is right around the NAV valuation, as you can see here. Um, Total assets, the 42 billion, liabilities, the 18 billion, the 1 billion and 8 shares gets us a NAV value of $23.89, which is essentially their book value. Um, and if you see here, without calculating that in there, this aggressive model gives us the $40.45. But that's not the model that we're going to be doing because I like to give myself a discounted cash flow. But this may be good for people that are getting a higher number for VICI as well. So I do think it's a great company. You really can't go wrong with it. Um, if you do like Seeking Alpha, they have a ton of stuff that you can look at here for them. Um, I kind of just look at it to give me a rough estimate of based upon what they're projecting and what I came up calculated with based upon old assumptions and new assumptions, which is right around. Let's see, dividend growth rate. They're saying 7.82% the trailing 12 months. So yeah, that's kind of around the 6% they just did and the 6% I said. Um, they're projecting their AFFO growth rate of 6% year over year. Well, forward it's 7%, right around where we are, but that's just historically speaking. They really do. If you want to go to VICI and you go over to their investors page, you can come over here. This is give you a better idea. You want to kind of look at over things. They give you a better understanding of their investments, how many restaurants they own, including the Great Wolf Lodge, which if you haven't been there, those places are fucking amazing. Sorry for my language. But yeah, so you can just come over here. You can look at their credit ratings, their analyst coverage, their SEC filings, their meetings, presentations, financials. Always visit the investor pages for places that you want to invest in. Get a better idea. It'll let you know what kind of places that you're investing in. I'm surprised VICI hasn't gone lower because look, including Caesar's Palace, MGM Grand, the Venetian. As you haven't heard what happened in Vegas, Vegas was attacked, and there were people, especially at MGM Grand, that were left without being able to get into their rooms. They were down for days. They were losing millions and millions of dollars, and they were trying to get extorted. There's all kinds of things that were happening. So VICI's holding up pretty strong despite all that happening, and that's good to know. But anyways, this is my valuation of VICI. I do have some of them in my portfolio. If they go under $30, I may look to a little bit more, but it depends how much percentage of it is in my portfolio at the moment. Um, but if we come over here, the final valuation, see, we have this right here. I would like that 20% discount rate because it would get me under the $30 and it'd give me a margin of safety. And let me know what you think about VICI and if you own it, and if you think I'm overvaluing or undervaluing them. I appreciate your opinions and thoughts. Thank you.